Our next guest says the market sell-off could be entering a new phase. For more on what he means by that, let's bring in Mohamed El-Erian. He's chief economic advisor at Allianz and the president of Queen's College at Cambridge University. Mohamed, when you say a new phase, is this a good new phase or a bad new phase?
No, it's a worrisome new phase. Becky, the big question for me is why haven't we had more of a bounce in what has been a relentless period of 7 to 8 weeks of weekly declines? And I think the answer is because we continue to get bad news. Think of Friday 10 days ago. We had a wonderful bounce. Then comes the new week. Then comes Walmart. Then comes Target. And suddenly we have legitimate concerns about growth and earnings. So we need to get these worries out of the way before we can establish a good bottom and get a sustainable bounce.
Looking at statistics, looking at the numbers, the Dow did something last week that it hasn't done in almost 100 years. It's been 99 years since the Dow ended down for 8 weeks in a row. Maybe that goes to your point, just the idea that this has been a slow and painful process. Steady, and so people say that doesn't concern the Fed. This is still orderly at this point, but it is steep and it is painful and it is consistent.
It is. And even if it were to concern the Fed, and it doesn't concern the Fed because market functioning has been fine, and that's really the silver lining. But even if it were to concern the Fed is highly constrained. The inflation isn't going to go away anytime soon. And the Fed just can't go back to its old habit of being there, of having a Fed put, of injecting liquidity. What we see now is that the Fed is constrained. And also, the Fed must keep an eye on the fact that the 60-40 portfolios have done really badly. And that's because the safe haven characteristics of government bonds were totally distorted by Fed intervention. So I don't think the Fed steps in anytime soon.
Hey, Mohamed, I'd love to get your views on this. I was at a dinner last night where there was a great debate among two very well-known CEOs, one of whom thought this was an 18-month, at worst, scenario. Another had a view that this was actually going to be a 3 to 4 year, if not more, prolonged situation, and actually that the equity market was actually not going to really flush out till 2024 based on the fact that he believed earnings were going to continue to decline, and because we haven't really seen that in a truly meaningful way. Which side of that debate here in Davos would you take?
Yeah, but if you're sitting in the real economy, you're not just worried about inflation, profit margins, and growth. You are seeing a global economy that's being rewired by government and geopolitical issues, rewired by your own desire to build in resilience. Forget about the just-in-time. You now have to have a lot more resilience built in. So when you look at that outlook, both externally and internally, you'll find that people in the real economy are even more negative than people in the financial sector. And that's what I think you're picking up at that dinner when people say, is it 18 months or is it longer? It's the structure of the global economy that they are operating in is uncertain and is certainly changing.
But does that mean that you're taking the side of the longer?
Yeah, I think we've entered a period where multinationals in particular, are going to have to rethink about how they approach a global economy. This is no longer a world of ever deeper trade and financial integration. This is a world where you're going to get fragmentation because of the geopolitics and because of your own decisions to increase resilience. So I do see an uncertain period for CEOs that operate globally. Not so if you operate nationally. The U.S. outlook is much better than the rest of the world.